Yesterday, the euro hit a new one-month high, but then slid way down by downbeat data on consumer confidence in the euro area. US weekly initial jobless claims and new home sales were nearly in line with economists' forecasts, which did not have a severe impact on the market dynamics. A decline also stemmed from the fact that buyers began to lock in profits by the end of the week. As a result, the euro trimmed early gains posted following the Fed's interest rate hike. For the time being, the European currency seems to have stabilized, but it is still likely to continue its downward correction. As for the British pound, a policy decision taken by the Bank of England yesterday met market expectations. The regulator raised the rate by a further quarter of a percentage point to 4.25%. In a statement accompanying the decision, the Bank of England said that it intends to prioritize fighting inflation, adding that the UK banking system remains resilient. Against this background, the pound sterling tried to break above the March high but came under pressure, entering a bearish correction. And now let's take a look at today's macroeconomic calendar. It includes statistics on UK retail sales. British retailers are expected to report slower sales growth in February. However, this indicator will hardly affect the pound sterling. Traders may also take notice of data on manufacturing and services activity in Germany and the euro area. The purchasing managers' indices are forecast to rise slightly, which may support the euro in the first half of the day. Britain and the United States are set to release similar statistics. British manufacturing activity is anticipated to expand, while activity in its services sector is forecast to contract. Meanwhile, US factory and services PMIs are likely to dip, indicating contraction in both sectors. Furthermore, it is worth paying attention to durable goods orders in the US. However, I think that the quotes will go down whatever the macroeconomic indicators are. After all, a downward correction in both the euro and the British pound is long overdue. From a technical point of view, 1.0840 acts as an intermediate resistance on the euro-dollar chart. A false breakout at this mark will create a sell signal, bringing the euro down to 1.0801. If the price fixes below this level and tests it from the bottom up, an additional sell signal will be generated. In this case, the euro will drop to 1.0761, where I recommend going long on a rebound, counting on an intraday correction of 25-30 pips. Long positions at 1.0801 can be considered only amid a false breakout. Alternatively, if the price breaks through 1.0840, consolidates above this level and tests it from the top down, traders may add long positions in the hope of surging to 1.0879 and even 1.0929. At these levels, it would be a wise decision to go long on a rebound, trying to make money on a correction of 30-35 pips. Speaking of the British pound, it is currently trading at around 1.2284, the middle line of the sideways range. In the best case scenario, the pound sterling may advance to 1.2337, the upper boundary of the sideways range, which will make it possible to sell the pound-dollar pair at a better price. In case of a stronger rise, traders are recommended to go short at 1.2388 to catch an intraday correction of 35-40 pips. Alternatively, a false breakout at 1.2284 in the first half of the day will also create a sell signal. Thus, the British pound will slide to 1.2227, the lower boundary of the sideways range. At this level, it will be possible to go long amid a false breakout, counting on a return to 1.2284. Long positions on a rebound will be relevant at 1.2181 with a view to a recovery of 30-35 pips. Good luck and have a nice weekend.